Hello class, this tutorial is on dividends and stock splits. So how are dividends and stock splits accounted for? A profitable corporation may make distributions to stockholders in the form of dividends. This would be the equivalent of withdrawals from the sole proprietorship. Stockholders may or may not receive dividends. If the company would have to declare a dividend in order for them to receive it. Dividends can be paid in the form of cash, stock, or other property. We'll be looking at cash at this point. Legal capital refers to the portion of stockholders' equity that cannot be used for dividends. 3 dividend dates are relevant. Declaration date. The board of directors announces the intention to pay the dividend and a liability is created. Date of record. This is the date in the corporation records the stockholders that will receive dividend checks. There's no journal entry for this date. It's just a date of when they're going to decide just exactly which stockholders will share in the dividend. And then the payment date. This is the date the dividend is paid to the stockholders. So its cash will be credited and dividends payable will be debited to get rid of the liability. So on May 1st, SmartTouch Living declares a 5-cent per share cash dividend on 22,700 outstanding shares of common stock. So on May 1st, they declared the dividend, cash dividend, 5 cents per share, times 22,700 shares, comes out to $1,135. Dividends payable, common, the liability, so this is the date of declaration. Cash dividend, which is a temporary account in equity, a contra account, and the dividends payable, common, the liability. That's the date that the dividend was declared. On May 15th, the date of record, no journal entry is recorded. And then on May 30th, SmartTouch Living pays the dividend to shareholders. So dividends payable, the liability is debited, and cash is credited in payment of the cash dividend. Cash dividend rate on preferred stock is often expressed as a percentage of the preferred stock par value, such as 6%. Sometimes cash dividends on preferred stock are expressed at a flat dollar amount per share, such as $3 per share. So it's given to you at that point. You wouldn't have to calculate it. Again, preferred stock gets dividends before common stock. It's more like a loan than it is an equity, but it's still an equity form. So Greg's Games Inc. has 1,000 outstanding shares of 6%, $50 par value preferred stock. The dividend is computed as follows. Number of outstanding shares, 1,000, times the par, $50, times the value per share, or the percent, 6%, comes out to $3,000. So this is the amount that is paid to preferred stockholders from any dividend that's declared. So they would get their $3,000 before common stock would get anything. Preferred stock dividend in arrears is a dividend that has been paid for, that has not been paid for the year. Preferred stock can be cumulative preferred stock whose owners must receive all dividends in arrears plus the current year dividend before the corporation pays dividends to common stock. Non-cumulative preferred stock whose owners do not receive past dividends. So on a cumulative, if the company in the first year doesn't declare a stock, the preferred stockholders, if it's still cumulative, they receive nothing that year. But in the next year, if they do provide a dividend, they'll owe the preferred stockholders from the year that they didn't pay out the $3,000, and then they'll owe them $3,000 from the current year. If it's non-cumulative, they don't have to pay the arrears from the first year. They just owe what the current year is. And again, they get these before any money goes to the common stockholders. So Greg's Games Inc. has 1,000 shares of 6% $50 par value cumulative preferred stock. In 2005, the business did not pay a cash dividend, which means they would have $3,000 in the arrears. On September 6, 2026, Greg's Games declares a $50,000 total dividend. So that's total going to preferred first and then common stockholders. So the total dividend is $50,000. The dividend in arrears to preferred stockholders for 2025 is $3,000. The current year dividend for 2026 is $3,000. So preferred stockholders get their $6,000 dividend. That covers the $3,000 in the arrears from the year before and the current dividend. Subtract that from this year's total dividend of $50,000. $44,000 is available to the common stockholders. That's the dividend available to the common stockholders. So dividend declared minus preferred dividends to common stockholders equals dividends available to common stockholders. So here's the cash dividend, $50,000. Dividends payable preferred, $6,000, and the rest goes to the common stockholders to be divided up amongst those shareholders. A stock split is fundamentally different from a stock dividend. A stock split increases the number of issued and outstanding shares of stock. Stock split also decreases the par value of the market value per share, whereas stock dividends do not affect the par value per share. So assume that Greg's Games has 3,150,000 shares issued and outstanding of $1 par common stock. The market value is $50 per share. Greg Games effect for a 2-for-1 stock split. So the common stock $1 par value at 3,150,000 shares issued and outstanding. This is before the stock split. After the stock split, the common stock par value would be cut in half, 50 cents per share, but the number of shares outstanding would increase to 6,300,000 shares outstanding. But the amount would stay the same. It's similar to a pizza. If you had a pizza with 8 slices, okay, for the whole, and then if you decided to make a split 2-for-1, so you cut it up into 16 slices, you still only have one pizza. It's just cut up into smaller shares, so the par value gets cut in half and the number of shares doubles. Just like the slices of pizza, the size of the slice gets cut in half, but the number of slices doubles. No formal journal entry is needed. Instead, the split is recorded in a memorandum entry, an entry in the journal that notes a significant effect but has no debit or credit amount. And again, a company may offer a stock split if it thinks its market value is too high. Okay, so the market value here is $50 per share. After the stock split, the market value would go down to $25 per share, which allows more shares to be purchased by the common stockholder. And if a stock price gets too high, people tend maybe not to buy it, so they bring the stock price, the value down to $25 per share, the par value down, which allows people to purchase more shares than they would before.